All right, welcome to another monthly recap. This is for the month ending in February 2024. So it was a short month, but not as short as most Februarys. Happy Leap Day. It was also an extremely busy month, both busy and not busy. It's kind of weird. We saw rates worsen quite a bit, 0.5% during the month. Not great. But we saw it react on less volume or less news than we would typically see. It's kind of almost like I want to compare it to like a holiday shortened week. Sometimes during holiday shortened week, there's a lot more volatility in the market because there's simply less traders working the trading grounds. I feel like February was kind of like that. Like we saw a lot of overreaction in the market to not a whole lot of data. And I feel like it was kind of almost due to like a holiday shortened week, except it was, a just shorter month. So it was Groundhog Day, Don't Drive Angry, President's Day, Leap Day as well. Yeah. So what happened in February? Jerome Powell talked about it being a quieter month. Well, anytime you see me talk about a 60-minute segment, that means it was a quieter month. Okay. So Jerome Powell was on 60 Minutes, had a lot of stuff to say. Going to talk about a couple things he mentioned. Job figures surprised at the upside. Inflation surprised in a worse way than we were hoping. Between jobs figures being really strong and inflation looking worse than everybody was hoping, it caused rates to jump. And rates moved from about 6.5% to about 7% throughout the month. First-time home buyer, good credit, less than 120% of the area median income, that kind of scenario, 30-year fixed. And then we saw, seasonal slowdown with regards to real estate values, but finished out the year. So we're going to be talking about that. And then impending partial government shutdown. I'm recording this the morning of February 29th. And there's a lot due to happen today. So we're going to be talking about all that kind of in real time here. So let's get to it. So Jerome Powell, like I said, anytime you hear me talking about a 60-minute segment, it was a slower month. So, but I mean, the market's completely overreacted to this. So Jerome Powell on 60 Minutes on the 4th of February, he talked about a number of different things, but he mentioned on whether the Fed will cut rates in March. I think it's not likely that this committee will reach that level of confidence in time for the March meeting, which is in 7 weeks. So traders kind of going into this were under the impression that the Fed was not likely going to cut rates in March. They already kind of went in knowing that. But then Jerome Powell said concretely, so anytime they say not likely, it's them saying it's not going to happen. they live in the gray area, but this is about as crystal clear as you're going to get from a Fed member. So they do not speak in concrete facts. They speak in abstracts. So, anyways. It's not going to happen. They're not going to cut rates in March. It was unlikely that they were going to before, but they just basically solidified everybody's thoughts. I like this comment a little bit more, and it was really relevant based on what happened later this week later that week with regards to inflation. So, on what kind of data is needed for the Fed to feel comfortable cutting rates? We just want to see more good data along those lines, i.e., what they've been seeing. It doesn't have to be better than what we've seen, or even as good. It just needs to be good, and so we do expect to see that. That was good news for the markets because what he's saying is like, look, it doesn't matter if we see 1 month of, inflation data that doesn't really make us happy. That's okay. It doesn't have to be as good as what we've been seeing. It just still has to be consistently good. That was really good news because, as I'm going to point out in a few slides, it was not a great month for inflation. It's looking more and more like a June for the first rate cut. When they do that first rate cut, it's going to be for a quarter, almost guaranteed. They very rarely start things off when it comes to either rate hikes or rate cuts. They very rarely do more than 0.25% to start. They don't want to spook the markets. They want to dip their toe in the water to see exactly how it's going to feel before they get really serious about it. Jobs figures were strong. So ADP was not strong. It showed only 107,000 jobs being created in January. Expectations were for 150,000. Okay, so ADP was not strong. How does the headline say jobs figures were strong when ADP was not strong? It was pretty weak. It missed by 43,000 jobs. BLS was so strong, it took everything that ADP had to say and just threw it out the window. So BLS, Bureau of Labor Statistics, that's the government's employment reports, showed 353,000 job gains. And expectations were for 180,000. So it almost doubled expectations for job gains. Also, if that wasn't enough, and it was certainly enough, the prior two reports were both revised upwards by a combined 126,000 jobs. So the Fed's perspective is, hey, look, if jobs are strong, GDP is strong, and inflation is, stabilizing. Like, what's the rush to cut rates? Yeah, they're not necessarily wrong, except for the fact that it takes a long time for whatever they do to actually bear fruit. You can always just plant a fruit tree and expect to have fruits the first day. It's going to take some time. Well, the economy is huge. It's not like turning a jet ski. It's like turning a cruise ship. It takes some time. Anyways, seasonal adjustments. Now, this is why I said it was confusing. Job seekers are strong, BLS, but confusing. The reason it's so confusing is because of what they call seasonal adjustments. So seasonal adjustments are, if we take out those temporary job positions during the holidays, there's a lot of holiday hiring, temporary job positions, and then they're going to be laid off, or let go or finish their contract after a few months. It doesn't really make sense to add all those jobs to one jobs report and then subtract them out on the next jobs report. Probably not. And I agree. They want to make it a little bit less volatile than that. They do the exact same thing when it comes to agricultural. A lot of farm work goes in, a lot of farm work in the spring, a lot of farm work in the fall, the harvest. Like, doesn't make sense to add all those temporary jobs and then take them out of the equation. No, it'd make things look wildly erratic. So they removed those seasonal adjustments. Now, there's a lot of guessing that goes on here. They're never sure exactly how many jobs are seasonal or not. So there's a lot of kind of calculus voodoo that goes on. If they had not taken into account the seasonal adjustments, there would have been 2.635 million job losses. January is always volatile. That's the takeaway here. January is always volatile. We're going to honestly take these strong numbers and kind of set them aside because January has to be taken with a significant grain of salt because of all these seasonal adjustments that occur. Inflation. Inflation had a month to forget. So we get consumer price index. That's inflation as you and I feel it. We get producer price index. That's inflation as businesses feel it on the wholesale level. And then we get the Fed's favorite measure, which came out quite literally today, personal consumption expenditures, known as PCE. The Fed only cared about one number. It'd be core PCE. Core is if you remove volatile food and energy from the equation, just like you remove the volatile temporary positions with regards to the jobs reports, seasonal adjustments, so too do they remove volatile food and energy from the inflation when they calculate a core rate. That makes a lot of sense. Like, does it make sense to show inflation like peaking and ebbing and ebbs and flows based on like gas prices in a given week or month? No, probably not. Let's remove those. Let's focus on core. Let's focus on the core. So again, kind of acquired a month, but overreactions all across. The Fed had their, Jerome Powell had his 60 minutes, and then we got inflation figures from CPI and PPI. CPI, it showed that the core rate remained stable at 3.9% year over year. The expectations were for that to come down. Okay, the core rate for producer price index, it rose 0.5%, rose from 1.8 to 2%. Again, disappointing figures. We got Jerome Powell's comments, and then we fairly quickly after that got CPI and PPI, and but markets just tanked. I think the Dow fell 500 points. The rates increased by like 3/8 over a given week. It was absolutely a brutal week for the markets. And they still have not fully recovered, but they are starting to work on it, looks like. So let's focus on PCE. That's the one that the Fed really cares about. Okay, so PCE, core rate increased 0.4%. It decreased to 2.8% from 2.9%. This was right in line with expectations. So again, going back to Jerome Powell's comments, hey, we don't need to see data as good as we've seen. We just need to see good data. I would hope that this 2.8 from 2.9% would be that good data that the Fed's looking for. I think it's going to give the Fed ammunition to say, hey, look, let's stay on our course. Now, they do meet in March. I think it's still incredibly unlikely that they're going to cut rates in March. I think it's really going to be that June timeframe. Housing. So housing continues to perform well, although we did see a seasonal slowdown. We did, since these numbers are for December, get the final all of 2023 numbers, and just why I wanted to kind of talk about this very briefly. So there's two different reports. There's FHFA and then there's Case-Shiller. FHFA, Federal Housing Finance Agency. It measures loans with a conforming loan balance around $766,000 or less, okay? And it measures those for single-family homes, okay? So it's excluding cash transactions, no cash transactions taken into account. It's also excluding luxury listings, most likely. It's possible you buy a $3 million home and you get a $766,000 loan. It's pretty unlikely. You're either paying cash or you're probably going to get a jumbo loan, which is not counted into these, okay? So it's skewed towards the low to middle price point of the housing spectrum, and it only does it across the nation. So they saw home values increase 0.1% in December, 6.7% year over year. Case-Shiller, gold standard. It measures all spectrums, cash transactions, luxury listings, low price points, does not matter. across the entire spectrum. And they do one thing better, which is they break it out by the major metropolitan areas. Okay, so Case-Shiller, it showed up 0.2% in December and up 5.5% year over year. Again, FHFA is skewed towards the lower end of the price spectrum. Given that, it's probably going to show higher appreciation because there's more competition for those homes, as opposed to luxury listings where you're not going to see that exact same effect. With regards to the major metropolitan areas, Denver finished at the bottom, 3 from the bottom. So only Dallas and Portland were lower than us. Now, there's a couple ways you can see this, right? You could see this as a negative. Hey, we're below the national average of 5.5%. Hey, we're ranked 17 out of 20 major metropolitan areas. But given that Colorado was near the top post-pandemic, I actually think it's a good thing. Okay, we saw significant appreciation after the pandemic, and Denver was one of the top performing metropolitan areas at that time. So if we had continued to be at the top, it would be a little bit concerning because that affordability issue is becoming less and less. It's going to keep pushing more and more people towards the margins. Like, we all want to see home values increase, but it should be a stable increase. I don't want to be Southern California. Two of the top 3 areas were Southern California. Southern California is renowned for its volatile real estate market. Like, I personally don't want to be in that. I would much rather have stable, consistent growth. People look back at 2007, 2008, the housing bubble popped, right? Like, in the lead up to that, Colorado was not going crazy with appreciation. We were consistently plugging along 3 to 5%. It was very, very stable and consistent. So when the market corrected and everybody was losing their homes, Colorado saw a very minor correction. We didn't have a lot to go. We didn't have this gigantic difference to make up. Well, when we're ranking so high on the top of this appreciation spectrum post-pandemic, that's not sustainable. That would create a more volatile real estate market. So it's okay that we're honestly on the lower end of it. And not only that, but we're still positive. So real estate should not be purchased on a transactional basis. It should not be done on hey, I'm looking to boom and bust with my real estate purchase. No, it should be a little bit more stable. It should be a stable, safe investment. So some people would see this as bad news. I actually see it as okay news, if not good news. It's still positive. And not only that, we don't want to be one of those really volatile areas. So we'll take stable gains all the way to the bank. All right, so government shutdown. We're recording this the morning of the 29th, and there's a lot that's going to happen quite literally today. So what happened in January? Mike Johnson, House Speaker, kicked the can for temporary funding bill, moved some parts to expire March 1st. On March 1st, quite literally tomorrow, Department of Agriculture, Energy, Transportation, VA, Veterans Affairs, HUD, Housing and Urban Development, FDA, those are going to have their funding expire. A week later, on the 8th, Department of Justice, Commerce, Defense, Homeland Security, State, Education, Interior, Health, EPA, and Human Services are going to expire. Now, what's likely going to happen? What's likely going to happen is they're going to pass another temporary funding bill. So you get to wait for another month of me talking about this. That's most likely what's going to happen. The House is going to have a vote midday. They're looking to possibly do a temporary funding extension, most likely still in March, but it would give them more time to come to a resolution. And the House finds itself in a very precarious situation. You know me, I try to avoid politics as best as I can, but here's what's going on. Okay, there's a very narrow majority with the Republicans, and a narrow majority can be even more challenging than no majority. And the reason why is because when there is such a narrow majority, it gives a small group of people more power than they normally would have. And still being apolitical here, it's the Freedom Caucus, right? I mean, they continue to throw their weight around, and they continue to demand a lot of things that most of their Republican members and liberal Democratic members have an issue with, and it's kind of a non-starter. And it's causing a pretty significant issue within their committee. So it's very likely that they're going to kick the can, punt on temporary funding. But what this is really doing is setting up for one big battle where there's going to have to be some significant compromises that occur to get a longer-term funding bill passed. So they keep kicking the can, but they're reaching the end of that alleyway, and they're like, oh no, where can we kick the can to now? They're going to have a pretty big battle ahead of themselves. Likely going to happen in March. It's probably going to be dominated in March, and it's probably going to dominate the news cycle in March as well. So strap in, get ready for it. Yeah, and then the question is like, how much more running room does Mike Johnson have? I know that the Republicans don't want to get a new House Speaker because last time they went with that one, it took weeks, quite literally weeks, to find a replacement. And as one member said, once you touch a hot stove, you don't want to touch it again. Well, they realize what happens when you oust a speaker and have to find a new replacement. They touch the hot stove. They don't want to do it again. But how much more room are they going to give Mike Johnson to do the job? It's a very challenging, precarious situation. And at the end of it also is like, is Ukraine going to get their funding? I mean, that situation in Ukraine is getting more and more dire, unfortunately. So, yeah, there's a lot on the horizon. Going to get some updated jobs reports, see if January is more of a blip on the radar, get updated inflation data as well. Hopefully that keeps going in the right direction. Fed has a meeting. Again, very unlikely that they're going to cut rates, but everybody's going to pick apart their comments to find out what the likelihood is of doing it middle of the year. And then, again, is the government shutdown averted? We'll know tomorrow. But for how long? How long? Are they going to punt until March, or are they going to give more breathing room than that? Yeah, it's a challenging, interesting situation. It's days of our House of Representatives. I wish it made better TV. They could make a killing on it. So, anyways, that's what's on the horizon. If you have any questions, as always, let me know. If you know of anybody that would benefit from this, please feel free to forward it along to them. It's truly my joy to serve. I hope that comes off. I really do enjoy this kind of thing. I really do enjoy the education and serving of our members and home buyers. So thank you all for the referrals. It means the world to me and my team. And yeah, we'll see you next Tuesday. Thanks. Bye.